Look at your screens right now, because what you are witnessing is a complete defiance of economic logic. We are seeing a total gold and silver bloodbath. While the Middle East teeters on the edge of a full-scale regional war and global tensions hit a boiling point, the very assets meant to protect you are being dragged into the abyss. This is the safe haven paradox, and it is catching millions of retail investors off guard. If the world is on fire, why are gold and silver melting down instead of mooning? The answer lies in a brutal phenomenon known as the ATM theory. We are not seeing a loss of faith in precious metals. We are seeing a desperate scramble for liquidity. Right now, major institutional players are facing a massive equity bloodbath in the broader markets. When the stock market craters and margin calls start screaming, big banks and hedge funds don teeth sell their losers. They sell what has value to cover their debts. They are using gold and silver as their personal ATM. They are liquidating their most liquid winners to keep their entire portfolios from collapsing under the weight of high interest rates and failing tech bets. The current price reality is staggering. Since the start of Operation Epic Fury, gold has dropped by a stunning 2.2%. That might not sound like much until you realize the sheer volume of wealth being wiped off the balance sheets in a matter of days. Silver has fared even worse, being absolutely crushed by nearly 6%. We are seeing silver break through key support levels that analysts said would hold for years. This isn't just a dip, it is a forced liquidation. The United States dollar is currently crushing everything in its path, acting as a wrecking ball to the commodities sector. In this opening chapter, we are going to break down why the safe haven trade has temporarily broken, and why the physical reality in places like Dubai is telling a very different story than the paper charts you see flashing red right now. We cannot talk about the bloodbath in gold and silver without looking at the predator in the room, the United States dollar. The dollar index, or the DXY, isn't just rising, it is acting as a global wrecking ball. As of this morning, we have seen the DXY break clean through the 100.5 level, hitting a 9.5-month high of 100.48. This move is sending shockwaves through every corner of the commodities market. When the greenback flexes this kind of muscle, gold and silver almost always take the hit. It is a simple matter of math. Because these metals are priced in dollars, a surging currency makes them prohibitively expensive for international buyers, suffocating demand at a time when the world needs a hedge the most. But why is the dollar winning so decisively right now? It comes down to a massive pivot from the Federal Reserve. For the better part of last year, the markets were betting on a series of aggressive rate cuts. Those dreams have been officially torched. The Fed has effectively scrapped its rate cut roadmap for 2026, and the reason is simple: energy-driven inflation. With crude oil hovering at $100 per barrel, the central bank is terrified of a second wave of consumer price increases. They are being forced to keep interest rates higher for longer, which turns the United States dollar into a high-yield magnet for global capital. Think of the global currency market like a beauty contest where every contestant is covered in mud. The euro is struggling with stagnant industrial growth, and the yen is in a historic death spiral. In that environment, the United States dollar is the cleanest shirt in the dirty laundry. Investors aren't necessarily buying dollars because they love the American deficit. They are buying them because they are terrified of everything else. This flight to cash is the primary driver behind the silver crush we just discussed. The impact on crude oil cannot be overstated. Earlier this week, we saw oil spike toward $119 as the geopolitical situation worsened. Usually, high oil prices are a signal for gold to rise as an inflation hedge. However, the sheer velocity of the dollar's climb is neutralizing that traditional relationship. We are in a rare market regime where the dollar and oil are rising together, leaving precious metals caught in a pincer movement. If you are watching the charts, you need to keep your eyes glued to that 100.48 level on the DXY. If the dollar stays above that mark, the pressure on gold and silver will remain relentless. We are seeing a total repricing of global risk, and right now, the market decided that cash is king, even if that cash is losing purchasing power every single day. This is the mechanical reality of the crush. It isn't about the long-term value of silver. It is about the short-term dominance of a currency backed by the most aggressive central bank on the planet. While the currency markets are being dictated by the Federal Reserve, the physical world is being reshaped by Operation Epic Fury. We are now entering the second week of a massive, coordinated military campaign as United States and Israeli forces continue to hammer Iranian infrastructure. The volatility we are seeing in gold and silver is a direct reflection of the terrifying uncertainty surrounding a potential ground invasion. For days, rumors have swirled that the Pentagon is preparing to put boots on the ground to enforce regime change following the assassination of the Supreme Leader. This isn't just speculation anymore. We have confirmed reports that the Department of Defense has approved the deployment of a Marine Expeditionary Unit, along with a powerful flotilla of warships to the region. Now, we have to be realistic about the geography. A full-scale ground invasion of Iran is a logistical nightmare. The country is protected by the massive Zagros Mountains, and history shows that invading the Iranian plateau is one of the most difficult military feats on Earth. However, the markets don't care about difficult, they care about possible. The mere presence of 10,000 interceptor drones and thousands of Marines off the coast is enough to keep the fear premium in oil sky high, while paradoxically forcing investors to dump gold for cash as they prepare for a wider global conflict. The primary target of this campaign has been the backbone of the Iranian economy. President Trump recently confirmed that United States strikes have hit military installations on Karg Island. If you aren't familiar with Karg, you need to be. This tiny coral outcrop handles roughly 90% of Iran's crude oil exports, loading up to 7 million barrels per day. While Iranian media claims the oil facilities themselves are still standing, the strategic threat to the Strait of Hormuz has already sent crude oil on a wild ride. We saw oil peak at $119 per barrel earlier this week, and it is currently hovering just under the $100 mark. This is the ultimate black swan for the metals market. Usually, when war breaks out, you buy gold. But when war threatens to shut down the Strait of Hormuz, through which 20% of the world HUS oil and liquefied natural gas flows, the resulting economic shock is so violent that it triggers a global margin call. The world is witnessing a total breakdown in traditional correlations. We are seeing hospitals and schools in the region caught in the crossfire, and the human toll is rising alongside the economic cost. The leadership vacuum in Tehran is adding fuel to the fire. With rumors that the former leader's son, Mojtaba Khamenei, has been wounded or disfigured in recent strikes, there is no clear authority to negotiate a ceasefire. The Iranian foreign minister has remained defiant, stating that they are waiting for an American ground invasion and that it would be a big disaster for United States forces. This level of rhetoric ensures that the risk premium isn't going away anytime soon. For you as an investor, this means the blood in the streets phase is likely not over. We are watching a high-stakes game of chicken between the world's largest military and a cornered regional power. If that ground invasion moves from rumor to reality, the current liquidation in silver and gold could flip into the most violent short squeeze in history. But until that pivot happens, the fear of a total energy collapse is keeping the dollar dominant and the metals under extreme pressure. While the charts in London and New York show gold and silver in a freefall, a completely different story is unfolding on the ground in the Middle East. We are witnessing the total paralysis of the physical gold supply chain. Dubai, the world's second largest gold exporter, has been effectively cut off from the global market. This city is the indispensable air bridge for physical bullion, handling roughly 20% of the world's gold flows every single year. But right now, that bridge is broken. Because of the escalating conflict and the proximity of Operation Epic Fury to commercial flight paths, almost all passenger and cargo flights out of Dubai International Airport have been grounded or diverted. This is a massive problem because gold doesn't travel on slow-moving ships. It travels in the belly hold of passenger aircraft. A single flight can carry up to 5 tons of gold, worth approximately $830 million. With the airspace over the Persian Gulf designated as a danger zone, insurance giants like Lloyd's of London have pulled coverage or hiked war risk premiums to astronomical levels. Logistics providers have been forced to halt exports entirely. This means that while paper gold is being sold off to cover margin calls in the West, physical gold is becoming a ghost in the East. It is literally trapped in the desert. The hidden insight here is the dramatic disconnect in pricing. In a normal market, gold trades at a similar price everywhere. But right now, we are seeing a massive regional dislocation. Before this conflict, gold in the Indian market was trading at a discount of nearly $50 per troy ounce. Today, that discount has completely evaporated, with Indian prices swinging back to match or even exceed London parity, because they simply cannot get the metal delivered from Dubai. The World Gold Council has warned that this halt in Middle East flights has created an emergency in gold procurement for the world's largest consumers. Traders are desperate. They are exploring moving gold by road to alternative airports, but that is a nightmare. Transporting hundreds of millions of dollars in bullion overland through a region on the brink of a ground invasion is a security risk that most insurers won't touch. You would need armored convoys and cross-border military escorts, which are currently impossible to coordinate. The longer these flights remain grounded, the wider the basis between paper and physical gold will grow. What we are seeing is a liquidity trap. Gold owners in Dubai are sitting on billions of dollars in assets they cannot move, while traders in London are selling paper contracts because they fear they won't be able to settle them with physical metal. This is exactly what happened during the lockdowns of 2020, and we saw gold prices explode once the delivery routes finally reopened. If you are a physical stacker, you need to understand that the spot price you see on your phone is increasingly becoming a fiction. The real price is what it costs to actually get a bar of silver or gold into your hands, and as long as Dubai is stuck, that price is going nowhere but up. We have looked at the chaos, but now we have to ask the most important question. When does this bloodbath actually end? To find the bottom, we have to look past the retail panic and follow the smart money. Despite the flashing red lights on your trading apps, institutional dip buying is happening at a massive scale behind the scenes. While small investors are being shaken out by the volatility, global funds have quietly poured $1,788 million into silver exchange traded funds during this most recent price drop. This tells us that the big money views this as a temporary liquidity event rather than a fundamental collapse. Technically speaking, we are watching two major lines in the sand. For gold, the $5,000 level is the ultimate psychological floor. We have seen significant support there, and as long as we stay above 5,000, the long-term bull case remains intact. For silver, the $80 mark is the battlefield. If silver can hold $80 amidst this dollar surge, it sets the stage for a violent move higher once the margin calls subside. Analysts at major firms like JP Morgan are still forecasting gold to reach $5,250 by the end of the year, provided the initial wave of institutional selling exhausts itself. The coiled spring effect is real. Once the physical supply chain through Dubai reopens and the paper markets stop being used as an ATM, the catch-up move could be legendary. However, we must address the Strait of Hormuz risk. If the military conflict escalates into a permanent closure of that waterway, we are looking at a total supply chain collapse for metals. In that scenario, the spot price becomes completely irrelevant because there will be no physical metal available for delivery at any price. This is why you're seeing such extreme volatility. The market is trying to price in the end of the world one day and a ceasefire the next. So, what is your action plan in this environment? First, keep your eyes glued to the 100.5 level on the United States dollar index. If the dollar breaks and holds above that mark, expect the pressure on gold and silver to intensify in the short term. You should also be monitoring the physical premiums in hubs like Dubai and Mumbai. When those premiums start to skyrocket while the paper price stays low, that is your signal that the bottom is in and the physical market is taking over. Do not let the bloodbath headlines scare you into making emotional decisions. We are in a structural bull market for hard assets, driven by $100 oil and a Federal Reserve that is trapped between a rock and a hard place. The current crushing of the metals is a mechanical byproduct of a dollar-denominated world facing a sudden shock. In summary, watch the ground invasion rumors, watch the flight paths out of Dubai, and most importantly, watch the 100.48 level on the DXY. If you can survive this liquidation phase without losing your position, you will be positioned for the next leg of this historic run. The world is changing fast, and while the paper markets are bleeding, the intrinsic value of what you hold hasn't changed a bit. Stay disciplined, stay informed, and don't let the margin call madness dictate your long-term wealth strategy. Want more? Like, share, and hit subscribe for daily updates.